My name is Mario Dumas. I'm a certified professional accountant and tax specialist. I'm the founder and partner of Dumas CPA, a firm that specializes in farm accounting and farm taxation. My role is to guide producers through major projects such as expansions, diversifications, and farm transfers, and help them evaluate the performance of their farms. Financial statements prepared by an accountant are a great tool to report financial results to farm owners and to financial institutions. What financial statements lack is an analysis of the relationship between these results. A net income on your income statement of $200,000 may appear to be very impressive or satisfactory, but if your loan repayments for the year are $250,000, your net income of $200,000 is not adequate. So to properly evaluate the performance of a farm or the feasibility of a new project, ratios need to be prepared and compared with industry averages and with prior years to establish trends and the potential of the farm. Dozens of ratios can be prepared, and if analyzed properly together, we can paint a pretty good picture of the farm's potential and performance. The most commonly used ratio, and probably the most important ratio, is the liquidity ratio, also known as the current ratios. Most farms have high values and good equity, but they're very cash tight. So liquidity ratio becomes important. To compare how much money is coming in within the next 12 months and how much money is leaving within the next 12 months is important. So we would compare the current assets with the current liabilities. Current assets from your financial statements include the bank account, your accounts receivable, your sales tax receivable, your prepaid expenses, and your inventory. Your current liabilities would represent your credit line, the amounts you owe to your suppliers, any income tax you owe, and 12 months of payment on your loan. So your total current assets would be compared with your total current liabilities. We would divide one by the other. If the number is bigger than 1, hopefully 1.2, your cash is probably adequate. If the number is under 1, your cash flow is probably too tight and we need to make some adjustments. One other ratio that we would use is the cost of production ratio to see if you're running the farm as efficient as possible. The cost of production ratio is an analysis between your total expenses of the farm with your total revenues. We would have to remove some of the expenses. We would remove the interest expense, the depreciation expense, and the salary of management. The remaining expenses would be compared with your total revenues. This would give us a cost of production ratio. If the cost of production ratio is too high, it means the farm is not run as efficiently as possible and some adjustments might need to be made. Another reason for your cash flow to be tight might be because your debt payment is too aggressive for the size of your farm. So we would do a third ratio called the debt service ratio, where we would compare your payments you're making within the next 12 months, your current liabilities, with your total liabilities. If your percentage of your current liabilities over your total liabilities is too high, let's say 20%, which would mean that you're paying your loans off in 5 years, that might be too aggressive, and that might be a reason why your cash flow is too tight. So adjustments might have to be made with your financial institutions. So already with just 3 ratios, we were able to evaluate the cash flow of your farm and maybe target what the problem could be between efficiency and debt repayment. Imagine what we could do with 12 ratios. Financial ratios can be either obtained from your accountant, from your farm advisor, or from your financial institutions. Just make sure that the ratio you use represent your farming sector, represent your region, and are current. Using good ratios will help improve your decision making.